Okay, so what you're going to cover is intro to options in the stock market, understanding call option and put option. So we'll discuss on that one. Understanding what is long and what is short. So most of you know what is long, but some of you have some doubt what is short. So we'll clarify that one. Understanding delta and theta. So these two are major Greek in the options. So when you trade options, you have to make sure that you know what is delta and what is theta. Then understanding expiration. This is um, another one which plays a major role. You have to know what is the expiration of the options. Then it's simple how to buy a call and how to buy a put. So we'll see that. Then understanding the spread. So we'll discuss what is a spread. Then there is something called debit spread. It's not only debit spread, there are a lot of kinds of spreads, but I'm going to cover only debit spreads. Also little bit touch on the credit spreads. But if you want a lot of spreads, because the spreads makes a lot of money and also a little bit conservative strategy. So from the options. So as this is very safety method, safe spread or safe trade. So we'll cover this one and we'll discuss that one. Basically how to open a debit spread and close it, how to open a ratio spread. We'll discuss it's how to combine this spread into ratio spread and close it. Okay. So these are the few things we'll cover. After that, if you need more info, then we can conduct another class. Okay. So whatever questions you have, you can write down and keep it towards the end. So let me go step by step. Okay. Also, I want to tell you why we are doing this one. Sorry. There is a 100K challenge coming up. What is this 100K challenge? Basically, we are trying to take 25K account. So basically, you will open an account with a 25K balance, and we'll take that account from 25K to 100K within a 12 months to 18 months period. Okay. So there are some criteria needs to be met. I'll send out a link where you can, basically this is the link. So where you can get all the information about this one, but this is the highlights. Okay? So you need to have a 25K separate account, and you cannot withdraw the money until the challenge is over. Trader makes sure not to use more than 80% balance at any given time. Suppose you have 100K, 25K. So basically, generally we say 70%, but 80% is maximum or more than that one. So basically 20,000, you should always be trading. 5,000 should be in your account all the time. And traders should know all these debit spreads and how to buy call, buy put. So those are the basic criteria. That's why I'm conducting this one, so that you guys are acquainted. Also, you can do some practice trading, which is called paper trading. Okay. So we'll see that on how we'll do that. Okay, now covering this one. Sorry, I don't know where to hide this one. Okay. So these are the options basic. This is theory, so you can get it anywhere in the internet, but this is let me read this one. Stock option is a contract between two parties. One is buyer and one is seller. Okay. So buyer, the holder, purchases the right, but not the obligation. I'll clarify this one. What is right and what is obligation? To buy or sell 100 shares of an underlying stock at a predetermined price from or to the option seller writer uh, with a fixed period of time. Okay, so we'll see that one in example. It might be confusing you, the big lines. I'll clarify you in few minutes. Okay, so there are two kinds of options. One is call and one is put. Okay, and call options confer the buyer the right to buy an underlying stock, while put options give him the right to sell. So that is the definition for that. So we'll discuss that one a little bit later. Then there is another one called strike price. Then another one is called premium, and another one is called expiration date. Premium is straightforward, which is nothing but whatever amount you pay, that is called premium. The option price, call or put, what you buy, whatever the price you pay, that is called premium. Strike price and expiration date, I'll cover in the next slide. Okay. So for better clarification. Okay. Again, the same explanation to this call. Call is an option contract in which the holder or buyer has the right, but not the obligation. So here is an example, okay? Suppose you found a house which is 500K, but you are not able to afford the house about 500K, okay? You say that you can arrange in 3 months, okay? So this is your 3 months is the period that you know that you can arrange that kind of money within the 3 months. So you talk to the seller who is selling the house of the 500K and asked him some time of 3 months. Seller agreed, but asked to sign a contract worth of 10K. So he's telling, okay, I agreed, I'll give you 500, I'll sell you the house in 500K in 3 months. Even if house goes to 600K, he cannot sell that house more than 500K to you. So he is asking you to sign a contract which is 10K. So 10K is your contract. So now the buyer has the right to buy the house at 500K even if the house goes up to 600K. Now the buyer has the right. Buyer has the right to buy the house at 500K even if the house goes to 600K. How much the buyer is losing in case he cannot arrange this 500? He's he's losing this 10K. If you can't buy the house in 3 months, then your max loss is 10K, as that's the contract. Okay. So on the other side, seller has the obligation. So here, who has the obligation? Seller. Seller has the obligation to sell you house at 500K, but buyer has the right because buyer is not obligated to buy the house at 500K. If buyer is not buying, he's just losing 10K. But seller, on the other hand, has the obligation to sell the house at 500K. Even if the house goes to 600, 700, he cannot sell. He cannot bargain with you to sell at 700K because he is obligated to sell you the house at 500K. So here buyer has the right, but no obligation. But seller has the obligation. So um, that is the fundamental of kind of options. So whenever you buy an option, so you have the right, not the obligation. I will show you in the example in few minutes. And put is just the opposite of the call. Okay. Now I just want to show you. I don't know why. Sorry, this one to side it here somewhere. Okay. So I just took an example of Microsoft. Microsoft is trading at 207 when I took this screenshot. And if you see in this one, this is a E-Trade platform. So you can see these are all expiration dates. I'll tell you how to get into this one. But if you can see here, these are all expiration dates. Remember I told you 3 months. So basically this expiration is only 3 months. So if December, so right now we are in December, 3 months is kind of March. So every month there is expiration, December, January, February, March, April. Sometimes they don't have an option for May, but they will open after January or February, they'll open one more option here. So April, then June 21, then July 21, then September, then January 22. So more the expiration, your more the option prices will be, we'll discuss that one. So this is called expiration dates. Then in the left side, you have a call and right side, you have a put. And if you see this color, those are called in the money. We'll discuss that one little bit later, ITM in the money. Basically, if you see 207, this is 205. So this side is call side, this side is put side. We'll see when you have to buy call and when you have to buy put. Okay. So, so this is expiration and this middle one is called strikes. Remember? So like if you want to buy, suppose you bought Microsoft this 210 call, 210 is the strike, and you paid 1300, 13 in 13.42, 13.42 each contract. So just note down somewhere each contract. When you buy one contract of this one, you are paying one contract into 100 all the time. One contract equivalent to 100 shares. So that's why when you buy one contract, that means you are paying 1 into 100. That means 1342 or suppose for the example 14, 14 into 1, 1400. So you are paying one contract 1400. Now after few days, suppose Microsoft goes to 230. Microsoft from 210 goes to 230, right? Now you have the right to buy this Microsoft and take into your account by paying the full amount 210. You don't have to pay 230, and you can enjoy the benefit of 210 to 230. Okay. So that is the right. So you have the right. Now the person who sold you this 210, so he will sell you that stock, Microsoft stock at 210. Microsoft is earning 230, so you are already $20 profit here. So you are $20 in the money, right? So if you buy 100 shares, so you bet 1400, then you can buy 210 call, even if Microsoft is trading at 230. So that was the call option. So basically call and put, when the stock goes up, I'll come back to that one. When the stock goes up, you buy call. When the stock goes down, you buy put. So when you buy a call, you expect the stock to move up, move up, move up. When the stock goes down, you'll buy put. So basically this put will value will increase and you'll make the money out of it. So call and put. Call when the stock goes up, put when the stock goes down. So we discussed, so this is expiration, this is strike, this is the premium, and then I'll come back to delta and theta a little later on. So this is overall. I'll come back to the example, real example in few minutes when I'll get into the trading screen. Okay. So you guys can ask any question at this point because this is a main screen. I just want to clarify if you got this point.
Okay, this is Gaurav. I have one question. How to customize this screen? Because I don't see this.
That I can tell you later on. So it's easy. You can have a, there is a column, extra column here. You can just select that.
Yeah, I never saw this screen in E-Trade.
Oh, really?
Okay.
Yeah.
Okay, you were talking about something like ITM and OTM.
Yeah.
Are you going to discuss later or?
ITM OTM doesn't matter on this one because that is a little bit more deeper thing. But
Okay.
yeah, ITM and OTM is very simple thing. I can just give an overview on that one little later on. Okay.
Yeah, sure. Thanks.
Yeah.
You explained the call very well
Yes.
with your analogy. Can you explain a little bit more about put?
Yeah, absolutely.
Okay.
Thank you.
So the put is basically the way we treat here on the call and put. The put is whenever you are expecting stock to go down, so you decide you have to buy the put because put is going to grow in the money. So regarding that that contract thing, right? So like suppose somebody bought 190, basically 190 put. Now the stock goes down to 180, right? Stock goes down to 180. So what they're going to do is, so here you are, when you buy this to here when you buy the stock, you are in the positive, that is long side. But here when they put the stock into you, that is in the short position. Short means like I'll come back to that one. So 190 they'll put you, okay. Basically you'll get the stock in terms of like short, okay. What is the negative? So if the stock goes down, still you are making money, like kind of 180. But by mistake, if the stock goes up, okay, then you'll be losing money. Getting my
Got
point?
it. Yeah.
Because your intention is, if the stock goes down, you bought the put, your intention is stock to go down. So if you short the 190, then buy it. So when you short it, like Shell at 190, then buy it 180. So your $10 profit here. But after they after they put you position like short, if the stock shoots up like 190 to 200, then you are losing to $10 here because you have to buy the stock at 200. Otherwise, you're going to lose money. You know, that's the thing. So when you sell higher, buy lower, that's how you make the money. But in this side, buy lower, sell higher. That's how in the money. That's the right. But most of the time, most of the traders, they make the money by just, they don't buy the shares. They just suppose, I'll come back to the delta point, which will clarify why they don't buy the shares at 210. They just play with the options. Okay. I'll tell you how is that one. Okay. So let me.
RK, I have one question. So what is
Yes.
the difference between like mark and ask?
Okay, mark is a specific thing from E-Trade. This is specific from a E-Trade. Don't worry on that one. This is the bargaining price. Okay, so basically, there is a bid, ask, and last price is there. I don't like those things because I need the medium price. So E-Trade will automatic bargain for you. Okay. So maybe sell is $13, $14. The bargaining price is $13.40. So I am going to pay this one. Okay.
Okay.
Because this is the E-Trade features, not with everyone.
Okay.
Okay, this one just mark into it. I'll go into the real time. Just before that, just clarify this theory. Okay, this is delta and theta. The major one is delta. You have to know the delta, the relations of delta in options. Okay, this is very good. If you understand, you can win a lot of situations. Okay. The options delta is the rate of change of price of the option with respect to its underlying securities price. The delta of an option ranges value from 0 to 1. So delta will always 0 to 1. It's not more than 1. For calls, 0 for calls, and 0 to -1 for puts. Okay. And reflects the increase or decrease in the price of the action in response to a 1-point movement of the underlying asset price. Let me clarify this. Okay. A call option is delta value of 0.7. So every call, I'm just taking the example of call. The same will be for put. Okay. So call option with delta value of 0.7 will increase by 70 cents when the stock move 1 point. So now see the example. If the option value bought $5, you have bought an option with $5 value and delta is 7 on that one. Then when the stock moves 1 point, what the option value will be? 5.7. So you made 70 cent profit. So for one contract, you paid $5, 500, and you made $70 on this one. So if you have 500 contract, you made 350 in this one. 1 point move. If the stock moves 2 points, 5 points, then 5 points, 5.7, 3.5. So option value will be 5 plus 3.5, 8.5. So if you have 5 contracts, you made a lot of money there, right? So that's how it's calculated. And clear?
And so, RK, who defines this? Who defines this delta? Oh,
Okay, that is by the option sellers. Okay, option there is option clearing house. Okay, or sorry, option OIC. Okay, I don't remember the full form, but there is a option. I don't remember, corporation, something like that. Okay, so they basically, these brokers, they get the feed from there. Okay, they don't have any control over that one. Okay, that is a separate entity. You don't worry
Okay.
on that one. You just have to see what delta you are buying. Okay. Okay, theta is just reverse. You have to see how much it will lose the value. Okay, option theta is measured on the options time decay. Basically, time is the time is the culprit. If you have enough time, you will make money. If you have a less time, this theta is going to kill your option premium. Okay, I'll show you an example. So suppose at $2 and theta minus 0.5, we'll experience a drop in 0.05 per day. Okay, so if you closer the expiration, the theta will be more. So that means you'll more lose the more value. Okay, like delta will, if the stock moves, delta increases your value. But if you don't have enough days, then the theta decreases by day. Okay, so I'll come back to that point. I'll show you that. Okay, so theory is little bit sometimes. Okay, ROI comparison. Who do you guys know ROI? Return on investment. Okay. So now I'm just giving an example. What is the difference between stock and option? What is your ROI in stock and what is your ROI in option? Okay. Suppose you buy 100 Apple at $114. You are paying 11,400. Now Apple moves 5 points upside. So Apple trades at 119. Then you are selling Apple at 119. You are getting how much? 11,900. Basically 500. You are making 500 profit. So profit percentage 500. This one 4.386%. Okay, 4.4%. So you spend 11,400 on 100 Apple and you are making 4.4%. Now in this example, the same thing you take it. You buy one call, 114 call, 4.5. Debit, you are paying 450 because one call is 100 contracts. Okay. So sorry, one contract is 100 shares. So 450. You bought the delta of 0.6. Generally, we recommended 0.7, but 0.6 is fine. The example is 0.6. When Apple moved 5 points, option moved $3, right? 5 into 0.6. So now you're selling Apple the same call at 7.5. So you got 750. So what is the profit? 300. What is your ROI? 66.7% of our 450. So which one is better? People pay less money. So that means if he bought 11,400 of options here, you'll be seeing how much he'll be making. Instead of 300, he'll be making like 450, like 10, 20, 30 contracts, I think. 20 contract, 6,000. He can make easily $6,000, $7,000 exactly this move if you want to Apple comparison. So it will be more than 6,000 or 7,000 profit in this one with the same amount of money. The only problem is option will lose the value, stock will not lose the value. You have to make the money when the direction is right and it is moving in your favor. If it is not moving in your favor, you will lose all this money. But here you will lose, but you'll still hold the stocks. But here everything will zero. If you don't have the proper expiration, if you don't have the proper strike, if you don't have enough time, okay, and you trade in the wrong time, okay. That's why a lot of people say trend is your friend. If your trend is in your favor, this is your friend. If trend is not in trend is not in your favor, that's not your friend, okay. You are going to lose all the money. Like contract, if you don't make the money within that specific period of time, you lose the 10K contract value you signed up. Actually, this is the beauty of this one. Also, at the opposite side is you lose all the money, okay. So, but example wise, ROI is option gives you more ROI than stock. Okay. Okay, I wanted to tell you what is long and what is short. So if you see here, when the stock moves from here to here, that is upward direction. So this is called, so if you enter here, so and you are exiting here, that means you had a long. So when you open a position, you have to close a position. As long as you didn't close the position, that is not profit. You didn't get any profit or loss. That is unrealized loss or unrealized profit. So once you enter a call, that is suppose you buy a stock at 112 or something, 105. So that is long. Then when you sell, that is closed. So you buy this one, this is called open. And when you sell, that is closed. That means your trade is closed. Okay, that trade is considered to be closed. Otherwise, trade is still open. But that means position is that sticker is in your position. Similarly, short, when you see stock is going down, you short it here. So always try to sell higher, then buy lower. That's what you make the money. Exactly the opposite way of this one. So when you short, somebody says short means they're selling. That means they're expecting this will go down. Short. So you sell at 135. Then if you buy it here 105, you made $30 profit, right? So that is the same way. And you should have a proper stop loss when you're doing this one, because when you buy this, your total risk is 105 into 100, maybe 10,500, and you can totally lose this one. But when you short this one at 135, your loss is unlimited because you don't know how far the stock is going up, move up, right? So that's why you have to make sure that when you're shorting, you have a stop loss right above this one so that you can get out early. Okay, but you can also move the stop loss. That is different strategy. So you can still keeping your profits. If you have a 200, 300, 500,000, 10,000 stocks, you can realize 100,000, then 1,000, then 1,000 like that. Okay, in a stepwise, you can take the profits and still make the money till this point. And how to know when it is coming back, coming up, that is a different technical analysis stuff, and how far it will drop and all this stuff. I think that's our Steve is very expert in this one. So when you join the group, you'll get to know what we are analyzing, what he's analyzing, all this stuff. So we can get you some insights. Okay. So that's what we do. Now, long and short, pretty clear. Yeah.
RK, it's not very clear, but if it is going up, it means we are making profit, right? But you said that we are in loss if it is if we are selling at 135.
No. I said that if you buy here, there are two things. One, this is one. So you buy 105, you sell at 135. You made $30 profit, and this is called long. You buy low, sell high. That is long. Clear?
Okay.
Now, if you want to short, then that is another trade. Okay. So short means you sold this one at 135. That is another trade. Okay. That's not with this one. Is that clear?
Okay. Okay.
That means you opened a position by shorting. That means you sold this 135. Okay. Then your trade is open and it is going down. You buy it back at 120. So you made how much? $30 again, right? Basically, you did two trades. If you got this one, that means you did two trades. But if you just did this one, this is only one trade. So you sell higher, buy lower. That is your profit.
So
Clear?
how can I sell a stock if I don't own it? If I don't
Because
have any stock?
that's how your broker gives you the margin account. Okay.
Okay.
If you have like kind of 10,000 or 20,000, they'll give you 50% margin, so you can sell it. If you don't want to sell it like 135 stock, you can still short $5 stock, $10 stock, $20 stock, right? So 100 stocks, it's $2,000. If you have 1,000, they'll give you 1,000. Okay. So those things, it's easy. Okay. That means you are borrowing from someone. Okay. You are borrowing from the broker and you are giving them back right here. Okay.
Okay.
Okay, I'll come back to this one little later. Give me a second. So this is one of the account. Don't focus on this one. So if you want to go to trading here. So this is eTrade platform. The reason I follow eTrade because it's very easy graphic. I can see very easily background and stuff and very acquainted with this one. And they have a lot of features and options. Okay. And I'm really, excuse me, I am not really comfortable on the TD Ameritrade or the TOS platform, but I like this one. Okay, so, but anyway, if you are comfortable with that one, I have no issues. But I'll come back. So suppose we are taking just take example of Tesla. Nowadays it's going on Tesla, right? Tesla. Now Tesla, one stock is 663, right? So if you want to buy one stock, how much you are going to pay on this one? Like not one stock, 100 stocks, 66,300, right? Now this guy gives you an option like to buy kind of, you can buy an option instead of stock, right? So, but you have to make sure that for the new trader, I'm not going detail on this one, but I'm just telling you upfront. Always the new traders who wants to go long, okay, for you the better is buy anything above 60 days. So February 21, it is 53 days. I'll still say no, don't buy long. For new traders, always you have to buy above 60 days. Okay, that's the reason for that one. But follow this rule if you want to buy. or your best option is to go to any LEAPS. LEAPS is nothing but LEAPS. I'll talk about that later on, but anything 9 months older, 9 months expiration, more than 9 months are called LEAPS. Okay. So September 21 will be the perfect LEAPS if you want to, but that works like a stock. Okay. If you are not comfortable in the short expiration, then go the long expiration. Okay. Or you can go to January 22, or you can go to, I think they have opened a lot of January 23 too. So if you buy this one, you'll pay a little higher, but it will work like a stock. Okay. So let me come back to this. Suppose we are going to March, and March I'm thinking to, suppose I'm expecting Tesla will go to 700. So I have a $40 move expectation. I'm not showing you the chart right now. I'm just telling you the expectation, right? So now what I'm going to do is I'm looking for the strike, that 700, okay, $40 move. Then I told you, whenever you want, we are buying, always look for the 0.6 or 0.7 delta. So what is the 0.7 delta here? This is 0.7. Can you guys see this one?
Yes.
0.7. 0.7 is trading for how much? 120, right? Or 121. 121 into 100, you are going to pay 12,100. How much? 12,100. But this is expensive. But anyway, it's an example, okay? But I can show you the small one. Maybe I'll go to Microsoft after this, okay? So, but the beauty part of this one is if Tesla moves $40, so you bought 0.7 here, 12,400. Okay. Now Tesla is one time it will move $30, $40, $50, $60, something like that, right? So if suppose Tesla is moving $40, how much you are getting here? 40 into 0.7,
280.
kind of $30 it is moving, right? Okay. So one contract you are making 3,000.
Yeah.
Is that right? Right. So actually you'll make more than that, and because this 0.7 will be when Tesla moves $40, it might be 0.8 or 0.9 by that time. Okay. So basically 0.8, 30, 35 or something. So one contract I can make 3,500 or something like that. Okay.
It's
For one contract, we already paid 12,200, right?
12,200, and you will encash it another 3,500 on top of it. Okay. So,
Okay.
so you'll sell that one in 123 or 124, 25, something like that. Okay.
RK, delta value will not change if the expiration is near.
Yes, delta value will always change, but only thing is if you suppose, okay, look at here. So March 21, I was telling you about delta, right? So here is your delta. Where is the 0.7 here? Delta. This is 1. You don't want 1, right? 0.7. You see, this is the 0.7, but this is also theta is 0.44. Every day, if the stock doesn't move, this value will lose 0.44 cent only. Okay, at this delta and this price. Okay, and if you go higher, sometimes the thetas are more. Okay,
It's
but
okay. Sorry, RK. It's a 44 cents or it's a $44?
For actually 44, 100 into 44, yeah, $44. Okay.
$44, right?
Yes.
Yeah.
So
RK, on the expiration dates, when we say March 21, well, 21 is actually the year, right? March 2021. So, but what date in March will it expire? Is it the third Friday of the month?
yes, third Friday of the month.
Okay.
Every third Friday of the month, expiration, your options expires. Okay, so if you see December, but sometimes they open weeklies. So, but not for all months. If you see the front months, we'll have some weeklies. Okay, like this one. Okay. So look at here, the theta is here. If you buy this one, 0.7 here, you are paying $2,000. Okay, for this 650 strike. That means you can buy the stock at 650, but 2,000. But the problem is you have only 3 days left, right?
Right.
Okay. If this guy doesn't move, okay, like today it dropped and it went up to $10 or something, $20, then came down to 1.9 to close. But tomorrow if it goes down, today you bought it, now tomorrow it goes down, you lose the value on this one. How much will value lose? Every one contract you lose
185.
185. So if it
Right.
drops $10 or $15, the both the delta as well as this one will kill your option premium. Okay.
Okay.
So that means you don't have enough time, okay, to make that
Right.
money. That's why when you go higher the expiration, your option premiums are higher. Okay. Like you don't want to do this, then basically you can look for the small things like this one will be preferable, or maybe Apple. I can show you a little bit on this Apple here. I think Steve, you can correct me if I'm wrong. Okay. So if you see Apple has a perfect position, but the problem is you see Apple has already seen this point, whatever today it reached. Okay. This is the resistance line. Okay. This is the resistance line. And we are expecting, because the way Apple has positioned itself, so it's already at its resistance. So 1, 2. So it hit the resistance today. Do you think Apple is going to move? We are expecting, okay, because most of the technicals are telling it will move because the way it has hold its strength. But if you see here from here to here, it has no. See, it came down to here. If you see here, the nice move, if you guys didn't catch it, from here it moved and took a break, again moved, right? Now it has little bit hiccups here, but it is in a channel right now. If you see this one, 1, 2, 3 support lines, okay, 1, 2, 3 support. Now it came back, hit here, bounce, came back, hit here, bounce, okay, hit here, bounce, again hit here, bounce. This bounce is made you, whoever caught here at this point, they also made some money till this run. If in case you missed this run, then whoever caught at this point, they also made money on this run, okay. So, but even if you missed it, even if you got today also, you have a chance. But for this to work, you have to have a time. Okay. So once you analyze the chart and all the factors of the chart, there are a lot of things to check in the chart. It's not one day stop. You should be in a position to take a proper position and make some money from the options. Okay. So that's why a lot of time we recommend trades in the trade alerts. Also Steve analyzes it. So but Apple is in a good position, so I'll show you the example of Apple. So basically we're expecting Apple to move, suppose what is this one, 136, it closed, right? Suppose another $4 or it's an example of $10. So 36, 146. Okay. I think it can move easily 146. Now we go to Apple here. Now suppose in the 3 months, as I said that for the new traders, you don't go 60 days, you go more than 60 days. Okay. So your March 21 is the these things. Okay. March 21, and you want to do for 0.7. 0.68 or 0.7, it's not a much difference. So maybe, so this one, so you pay 1600, one contract you pay 1675, okay. It's like, it works like stock. Now it moves $10, how much you'll be making?
700.
Yeah, per contract 700, but I think you'll make more, but I'm just telling for the example, 700. So it moves $10 within 3-4 days. It moves it moves $10. You made 700. Okay, that's it. That's the calculation. And in case it goes up and down, you have 81 days to correct this one. Okay. In case it doesn't work, you have to follow your stop loss rules. You have to follow your exit process. Okay. So basically, most of the time I tell in our language, you have to be Abhimanyu. You have to be Arjun, not Abhimanyu. Abhimanyu knows how to enter, not exit. But you should be Arjun because you know how to enter and how to exit. If you don't know, follow some Arjun who are doing it. Okay, but you have to take a proper training, or you should follow someone. Is that clear to you? So if you are trying to do yourself, you don't know what to stop, when to stop loss or when to exit, that will be your mistake, because you will completely lose this money. Okay. So
RK, one more question.
yeah.
These detailed chart analysis, is this available on eTrade?
Yeah, chart analysis is available in eTrade, but sometimes you have to play some third-party tool or something. Okay, you can also do it. Yeah, you can also, even if you don't buy third-party, you can also use eTrade chart.
Which tool can you please repeat?
No, tool is different. Okay, so there are some third-party tools are there. Okay, charting
Okay.
tools. Like one is TradingView. Okay, this is a TradingView. You can pay some money, premium member. You can get some customize it, your chart and price alerts, everything. But this one will be little bit different. Okay, so you guys are clear on this one? Call, put, delta, theta.
Are you not looking at the strike price when you just shown a chart? You said 146. You are expecting it to go 146,
Yes.
and now I don't see you are looking at strike price. You are just targeting delta. What is that? I mean, how do we know that? Don't we need to look at 146 and do some prediction there?
You can also do that one, 146. Okay. If I target 145, your delta is 41, right? So you are paying less, and if the stock moves to 145 or 146, you are already in the money. Okay, and $10 move will make you $400 here. That is also possible. You can buy this one. The problem with this one is this is called out of the money. The less deltas are known as basically, if you see these color codings, the color codings are nothing but ITM, means in the money, but that basically 136 and 135. So because the price is more than strike price, so that's a call, it is in the money. So though the concept is same, we're supposed to see 145. You are not wrong on this one, but only problem is if the stock goes down, this is going to lose the value drastically. Then this in the money, like kind of 0.7 delta, they will lose the value very less than this one. So there is nothing wrong. A lot of people do this. They come and buy less, like kind of very cheap contracts here, and sometimes they lose. Sometimes a lot of time they make the money. Sometimes they lose. Okay, as long as that's what I told, for new traders, you should not concentrate on this out of the monies. You have to concentrate on the in the money. Okay, so
So in the money with higher delta, right?
yes, because it's like a stock moves $1, you made 0.70 cents. So that means $5 you already made the money. So you don't have to, you will not think that, okay, I didn't make the money. But the problem is if the stock doesn't move here, by the time you want to make that money, it has to move a lot. That's the reason. So.
But then in the money, then if it is a stock price, it's now $136. So, and if you choose 135 or whatever 0.7 delta, it means your price is 130. So, how does that correlation basically? If you are not, how are we making the money there? If the stock move or don't move, how that's work? The mechanism.
Now, if stock doesn't move, you will be definitely losing the money because the option price lose the money. Okay, if stock doesn't move, okay, it's basically theta will decrease the value as well as the your delta. That calculation, that is a Greek calculation. It is already factored in the OIC. So we have no control of this on how the premium will be shown. It basically, there are a lot of mathematical calculations. Means if you want to go detail on that one, there are some mathematical calculations that do it. But if you don't want to enter into this one, you just look into what is the price and what the price it is showing here, because they calculate a lot of factors, theta, gamma, delta. There is another one. So basically all the factors they check, and calculate the option prices.
Really, in 2 hours.
Okay.
So,
Hey, RK,
Mm-hmm.
this is Srini. So you talked about stop loss, right? I mean, are you going to cover that separately or?
No, stop loss I'm not going to
Um,
cover right now. Okay, I'll cover something else. Give me a second.
RK, quick question. This is Dhiren. If the stock like not move like $10, but if it is moving close to $5, $7, and then again it's going down. So how much we the daily loss kind of going back theta. So
Yeah, you have to see what is the theta is displayed there. Okay, so basically when you have a position, okay, like see this account is not mine. Okay, so you can see some positions he's losing, some positions he's making. Okay, so basically if you see Amazon, he called this one 3 June 4,000 calls. You see June 21, how many days is 172, right? How much money he made so far? The total gain is right now 1973. Today he made 7,004 because Amazon had a big jump here. If you see the Apple call, so you can see the expiration and see how he's making this money. So this is covered call. So this is again, hold on. I don't know. Is it this one? Okay. I think June is not here, but you can see how this 10 quantity and right now it is 1180 and then you can say delta, how much delta he has, right? So because of the 10.6 is 666 delta. So the moment it is moving,
Where is it?
so this is kind of profit, but whenever he's losing, you can see how much he's losing here. I don't know why he's losing one here. Okay, look at this one. Maybe he's losing all the money on this one. Okay. You see? So because the expiration is only 18 days and this WKH is not moving, okay, that's why he's losing. He should have exited from here, but I think he's not monitoring this account. Okay, otherwise the exit should be already done. Okay, so but this is a when you enter a position, you can see all the positions here actually in your position stop, and you can see how it is moving. Okay, say you don't have to exercise much. The only thing you have to focus is delta. Okay, but that is not the thing. Only thing we are doing. That is the concept I told you. But there are another thing there. There is something called spreads. We'll cover that one. Okay, which should interest you. Okay. So if you want to buy a call, you just select the strike price, then expiration. So see the contract, one contract, then expiration, then the strike, then automatically the price comes up. And you select the middle price. Most of the time you don't put fractions, say 1340, 45. Sometimes they'll tell you they're accepting or not. Then you just say preview and just send the trade. Then your trade will come into, like if you want to trade here, any Apple trade, and I want March. So I want to buy something, anything I want to buy right now, right? So, but this will not execute today. So buy this one, 135 call, I'm paying this one, say preview, and you can see debit I'm spending 1075, commission I'm paying this one, total this one. So he has total buying power right now 165. Okay. So send.
So RK, when to use day and when to use good till cancelled?
Okay, that's a good question. If you are already part of the trading, whenever you open a trade, that's a day trading, either open or short. Okay, but when you close, your closings always should be a GTC because you don't know it will close today or tomorrow, right?
Okay, so closing GTC and otherwise just use the day.
Yeah, just
but
to
if it
open a
what's
trade.
yeah, but if it is, let's say, only 15 minutes left in the trading on that day, would you still use the duration as day, or would you?
Yeah, if you are opening a trade.
Yeah.
No
Okay.
GTC, opening a trade. Okay.
Okay.
If I am opening a trade, always day trading. Day. Okay.
I see. Okay.
So this is how open a trade. Buy a call. What what is this one? Two things. Okay, I think copy it. Quickly, I'll tell you. So these are some of the alerts in our channel we post. Like you can see here. I'll come back to this one a little bit, so you can see in our trading channels. So basically here you can see all the trading alerts here. So whenever you join, you can see come to this open trading alerts, and here we'll be posting the alerts. And if you see 270 by 280, this is a spread. Let me explain you a little bit spread, then I'll jump into the another slide. Okay. I don't have the calculation here. I'm just telling you here directly. Okay. What is a spread? Spread is nothing but so when you buy a call, okay, buy a call, so that is long call, right? But when I combine another one with that one, so that will be a spread, like selling. So now suppose this is Apple trade. So Apple is moving up. I want to buy long, but it is expensive. Suppose this one 135, it is 1200, but I don't want to spend 1200. Okay, I want to spend less, or at the same time I want to little bit conservative. So that time you think of spreads. So spread is nothing but you buy this 135 strike and you are going to sell this 140. That is possible through these options. Okay, so you click on this one, then say buy. I'm buying 135. Always spread will have a buy, long and short, both positions, and both are in the open state. So let me change the strike to 140. Okay, so 135, 140. So you see this is a buy and this is a sell. If you just change this one, it will be like this. Okay, so this is a buy, this is a sell. So if you combine this is known as a spread. So remember, if I'm buying this one, I'm paying 1200 some 20. At the same time, I'm reducing my cost by selling. That means I'm getting some credit for this one. So I sold it, I got 140. Okay, so how much I got from this 10 or something, right? 9.95 per 10. At the end, they bargained it for me. Finally, I'm paying $230. How much? $230 for this trade. Okay, so with the $230, you are able to place this trade, and this is called a debit spread. You see, limit is debit. That means at the worst case, your total loss is 230 for this. How much you can make? I'll tell you the calculation. 135.40. What is the price difference? Strike difference is $5, right? This is a $5 strike. Okay, so I paid how much? 230. What is your maximum profit on this one? 5 minus you paid the debit. So 230. So 5 minus 230. What is the profit? 270.
270.
Your maximum profit is caps here. That means you cannot go more than 270 profit on this trade. Okay, this is the spread. That is the problem with the spread. If you want infinite profit, you just buy long call and you pay 1200. But if you are conservative and you are happy with the 270, then you do this. Okay, sorry, 240, sorry, 140. So I bought it. I know Apple is going to cross 140. So when they both will be in the money, I take my 230. I sell this one at maybe 5. So I made 270. Sometimes you may get out little bit before. Suppose you saw you made $200, you close the trade, nothing, no problem. Okay, anytime you can close it. Okay, after opening, anytime you can close it if it is possible to close you. Okay, so this is the spread. You want to make more, you can increase numbers here. Sorry, like you can 5 and 5. So how much you're spending? 1150. So if you want to make the same thing, so you can make $1,000 or $1,100 if it goes to 140 or above. Okay, so this is called spread, and the spread consists of one long and one short. One long, both are in open position. So if you want to preview, I'll show you here what it says. Buy 5 Apple, open, to open. Sell this one called to open. It is not
No, that-
close. Okay, it says open. Okay, that means both are open. Okay, then you play this and send this. Okay, I already queued it because even if it gets filled up tomorrow, I'm happy because this, I know the Apple is going to go up, and it's also more expiration. So that's no problem. Okay, I manage this account.
RK, how does this expiration works here? Is it the same as a call option and put option, or?
No, put option. Call is call, no put here. Okay.
No, I mean in the spreads, whatever you've shown us, the expiration you given as some date, February 21st. What happens if it is nearby expiration, the price will reduce? Is it something theta
Yeah,
and
at
delta
the
will come into the
expiration, yeah,
picture?
everything. If you don't close before the expiration, you might be losing all the values. Okay. If Apple closes, suppose Apple is closing by expiration, Apple is closing 150 or more, then you keep the whole premium. Okay, that $270.
No,
But
I understand.
some, yeah.
I understand that. What my point is, okay, in the call option, in the and the put option, I mean the naked call option, naked put option, you explained the expiration date is plays a major role, delta
Yeah.
and theta, delta
Yes.
and theta.
Yes.
Is it, even in the spreads, you are saying the expiration plays the major role?
Yes, of course.
For example, I have taken February 21st. I took it in January. I given the February 21st. Okay, if in the mid of February the price will reduce, even if I have a 140. I
If
mean
the
the profit
stock
will
is
reduce.
not reaching 140, definitely will losing the value. But if the
Okay.
stock is moving and going above 140 or short strike, that means your long is making you the money. Okay, because your long will be already in the money. Short will, that's why you're capping. That means you are covered. Basically, you bought it and you are making less money, but you are making money. But
Yeah.
if somehow the stock stays low, below the long or short, you'll be losing the money, and you will
Okay.
see that one in your positions. Okay.
Okay. I have another question, RK. Sorry. And you said the maximum profit is 270, right? In your
Yes.
example.
Yes.
What if the stocks goes to 160? Even if it reaches to 160 before my expiry date, the maximum profit I will get only 270.
Yes, exactly. That is your strike. Okay.
Okay. Okay. Got it.
So pretty much, RK, this seems to be like you're negotiating a lower profit for you in return for paying a lower premium, right? That's what
Right.
that's what this seems to be like.
It's not like
Yeah. Correct.
it's not like I'm bargaining. I'm trying to reduce my debit here. Like I'm trying my exposure, my risk. I'm reducing my risk here. Okay. So
Yeah, RK, could it be the case where we are putting in this spread, debit spread, and one of those two gets executed, other one doesn't get executed? So in the example,
no, that will not happen. Okay.
so it's okay. So it's actually one order. It's the whole thing or none.
Yes.
So the person who is sitting on the other side and buying it will have to buy the whole thing.
Exactly.
You don't worry, it automatically happens when the both will meet, it will execute, otherwise it will not. Okay. So because that's how the order is sent. So then the market broker will do that one. But only thing one will happen is it may fill you one order, one quantity, and it may not fill you the 4 quantities. So you may have one quantity, you may have other 4 quantities didn't fill, or 2 quantities filled, 3 quantities didn't fill. Something like that may happen. But it will not happen that one leg will fill, one other these are called legs. Okay. Sorry, these are called legs. So
Yeah.
long leg, short leg. So one leg, they will have to fill up both legs. Okay. Okay.
Yeah.
So this is called debit spread. So before the time run outs, let me finish one more stuff. Okay. Which everyone wants to know. Okay. One is something called covered call. Write down in your stop, called covered call. Okay. Most of you know about that one, and most of you don't know about that one. So I'll give you an example of here. Okay. If you see this Tesla, okay, and this guy has Tesla 300 stocks. Okay. How many stocks? 300. So if you have something stocks like this 300, 400, 500, covered kill is a very good option for you to make at least 30 to 40% per year. Okay. So how you can do it? Let me show you. You don't have to trade stocks, but if you have already stocks, if you are not doing anything, you can still make some monthly income out of it. Okay. So if you have 1,000 stocks or something, so like 300. Now this guy had sold this call, January 21, 740 call at what price? 29.46 right now. So when he sold it, that means he shorted this call. That means he wanted Tesla to not go above 740. Tesla to not go above 740. So the moment he did it, So he sold at 29.46. Right now premium is 10.4. The green means he's making the money because it is still Tesla is 660. So it's losing its premium. So when you sell something, if it lose the premium, okay, like short something, if you lose the premium, you are in benefit. So whenever you sell long side options, you lose the premium. On the short side, if it loses the premium, you make the money. Okay. So this is what is happening here. It has only 18 days. If Tesla doesn't reach 740 by January 21, January 15, then he's going to keep all these $10,000 in his pocket, $9,000. Okay, $9,000 in his pocket. If he decides to close it, because it is right now 64% profit, right? Tomorrow, if he decides to close it, he can also close it, and he can keep this one. But somehow, if the Tesla goes above 740, just think of this one. Why he sold 3? Because I told you one contract is 100 shares, right? So because he has a 300 shares, he can sell only 300 contracts, 3 contracts. He cannot sell more than this one. This is one factor to think. Okay. So one, yes, sir. So 300.
With
So
no rain.
hello. Okay. So now, sorry. So 300 calls he sold. So he has to expect that it doesn't reach the 740. Okay, suppose by mistake, somehow he didn't close it, but stock is reaching 750 by January 21. What happens? Do you know, guys? So what will
It
happen
will
is
automatically.
he has one option to do this. Okay, stock will called away from his account. Okay, and they will pay all the money whatever is here, and they will take the stock at $740. This guy is still at the money, still made a lot of money, 740. But only problem is he lost all the shares. Okay. The another thing we'll have is here is he can also do one thing. Whenever he sees stock is moving to 720, 730, he can roll this call or close this call and open another one. That is called rolling. Open, like he can sell 760, 780 calls, something like that, so that he can save his stocks. But if he doesn't want to save his stock, he wants, okay, let the stock goes away 740, I don't care. Then he just have to leave this one. Okay. So I'll tell
If
you. Yeah, tell me.
if he closed it before that date, he will not lose anything.
No, the problem is if the suppose our stock is trading at 745 before the expiry date, right? And somebody exercised their stock, okay? They want to buy at 740, okay? They will take this one out. That means they will
Okay.
close this. But you have
Okay.
to make sure that stock is trading below 740 and you can close that one before that or roll that one. Okay?
Yeah, my question is more or less the same. Let us think the stock is 720. I want to close it.
Yeah, you can close it. You can
Okay.
close it anytime. Okay.
Will it lose any money because the expiration date I have given still 18 days pending?
Depend. It's a 720. If tomorrow Tesla is going to 720, yes, of course, because most of the time what will happen is this premium will increase. Okay.
Okay.
Premium will increase means you lose the money because it's going towards the 740. Okay.
Exactly.
That's what it said.
So, yeah, so RK, that brings up a good point. While selling covered calls, I have hard time deciding what strike price to choose. Do you have some
Okay.
guidance on how to go about that?
Yeah, most of the time what you have to do is look for the see, that's where your sometimes chart analysis comes into picture also, because you want to sell somewhere in the strike level, like sorry, resistance level. Okay, so if you are trading selling in the in between, then that will be a problem. But otherwise, if you don't care about your stock losing from you from your buying price, then you can choose any strike a little bit which will give some money to you. Okay, the people who generate money, they have a different plans. Okay, at least look for the I'll say 15 days to 30 days, not more than 30 days. Don't sell it. That is one condition. Don't go more than selling 1 month. Okay, just sell either 1 month or 3 weeks or 2 weeks at least. Even 1 week you will not get enough premium, so that will sometimes lose you money. Okay, because if the stock all of a sudden goes high, so you'll be losing the money and you'll give the stock away. That's why I also don't sell covered calls, because I'm scared of stock will call away sometime. And that's why I don't do it. For few stock, only 3 stocks I don't do it, because I have Google, I have this Tesla, and I have this Facebook. These 3: Google, Facebook, Amazon. These 3 I don't sell covered calls. Okay. Sometimes if I see the hitting resistance, I do it. Otherwise, other stocks I continuously do it the covered calls. Okay. Because I don't I have no issues in selling if the stock is called away. Yeah. So sometimes what you do it, you sell something like 0.2 or 0.15 delta, so that you are kind of, by the time they reach there, it will, and if you sell 2 weeks or 3 weeks, so what will happen is time will work for you. Okay. Even if the stock is moving little, if the time is helping you, you will make the money, because it will lose the value because of the theta. So you can close the covered call in time. So did you get the concept of covered call? You have 100 shares, you can sell 1 call. Suppose Tesla, you have 100 shares, you can sell this, you bought it suppose 650. Now Tesla is trading 660. You go ahead and say you are targeting 740 or 750. You sell 740, 750 call. That means you are receiving this $900 to your pocket. Okay. So if Tesla doesn't reach 750, you keep this 900 into your pocket. Okay. And if Tesla reaches 750, they will take the stock away from your account, but you make the money, because 650 to 750, $100 move, 100 stocks, $10,000 you made, plus this one you receive. So 10,000 plus this 1,000, 11,000 you made from this run. But if you would like to keep the stock, then what you do is you close this one and open and sell another strike like 770, or you can go to another strike, another expiration. So if you want more than that one, yeah, I can definitely help you in the chat or something. Whenever you have that situation, I can definitely help you. But that's the concept of covered call. Okay. Covered call is only done through your, if you are owning any stocks with multiple of hundreds. Okay. It will not, suppose you are holding 105 stocks, you can sell only 1 contract. Even if you are holding 195 call, 199 stocks, you can still sell only 1 call. Okay. Remember that one. In order to sell 2 contracts, you have to have 200 stocks. Okay. So that's how the covered call, you can make monthly some income on this one.
How do we place the covered call? Is just a sell?
Yeah, just suppose you go here and say, I want to January 21, and you say, click here. Okay. Sorry, not this. Sorry. It will, the moment you say sell, it will automatically identify it, you have the stock or not. Okay. So then you say sell and say 1 and this one and say preview. Now, now we are unable to accept your order as entered. It could contact unsupported, because I don't have I don't have shares. Okay.
I got it right. Okay, thank you.
Because
RK,
already
one more question.
Yes, sir.
RK, so it means if my I need to buy covered call when my stock is not going up, or it's not moving, or it's going down, then I can buy covered call to cover my amount whatever I have paid for the stock. That's the concept of covered call.
It's not exactly that one, but definitely you can reduce some of your price. Yes.
Okay.
Yeah. People use it for making some monthly incomes, and they don't do it because you like the stock and you want to hold it for long. So that's how you play with this one.
So RK, are there 1 or 2 stocks which are ideal for making covered calls? It's really good.
Yeah, any volatile stock like Tesla is good one, but it is expensive, right?
Yes.
Then you can have AMD, you can have Apple, you can have Microsoft, you can have Facebook, you can have I think Square, you can have, there are plenty of numbers. Disney is another one. There.
So for
Okay.
covered call, delta should be less than 0.5. For covered call.
0.15 or 0.2. Don't sell more than that.
Okay.
Okay. Another important thing I'll just tell you before I wrap it up. That is called selling a put. Note it down. Okay. I think I thought I'll not cover, but I thought maybe it is useful for you guys. Okay. Selling put is a very good strategy for you. Okay. For any of the trader, for any of the beginners also. Suppose SPC, and you do this selling put, mostly recommendation is any stocks below $20, you try to do this selling put. Okay, that's the only one recommendation I have, and there is no restriction, only recommendation. Is that clear? So SPC is 23. It's a very good stock, space stocks, and you want to own this stock. If you see the chart, it was going higher here. It already reached 34 or something. Now it is down. Okay. Now you want to own this stock, right? You want to own this stock, but you don't want to pay right now. Okay. What you can do is January 21, you can sell a put. Sell a put also needs some margin. Suppose you want to buy the stock at $20. So what you do is you go here and $20, you sell. Suppose you want to buy 500 shares, so put 5 here. Okay. 5 contracts. That means they will assign you 500 shares. So 5 into 0.5, you receive $230. Okay. If I do this one, selling a put, I'm not buying. Okay. Buying is so selling a put is what is happening is when you sell a put, you are expecting stock to stay above 20. Okay. So that you can keep the money. So whenever you sell, you're a credit. This is called credit. That means you are receiving this credit to your account. Okay. But if stock comes down to 19, they will assign you the stock at $20. So are you getting my point? So if the stock comes back to 19 or anything below 20, they will means the option comes option OIC. Okay, they will assign this stock to your account. Okay, at what price? 20. That means you are buying this stock at $20 strike. Buying this stock at $20, and your stock buying price is $20. So 5 into 20, technically how much you are paying? One like 100 stocks, 2,000, 500 stocks, 10,000, right? 10,000, your actual price is you received 45. So 20 minus 45 is 1955 is your actual cost. But the moment you receive, what you can do is you can start selling the covered call. So it will reduce your stuff. But a lot of people do this because they want to make some monthly income. How do they do it? Suppose the stock doesn't come back to 20, what happens? You keep this money into your account. That means you made straight. You didn't do anything. You just sold this put and stay. So if you have suppose 20,000, 30,000 sitting in an account and you are not doing anything, you have no clue, just do by selling puts. You can do on your own, and it will give you at least 20-30% per year in per this one. This is one strategy without holding any stocks. Getting my point? This is a very good strategy for the people who want to generate some monthly income. You can also do it, but look for the stocks which are less than $20, $20 or $25 or $30 maybe, and you like that stock. It's not like that any stocks. Okay, that means you want to own that stock. Okay, like SPC. This is one of the stock people wants to buy it, or maybe Bank of America. It is very less in price, I think. Something like that. You have to find out. If you don't have any idea, you can check back with me when you join the group. Okay, if you don't join the group, then don't expect anything. Okay, so that is by selling a put. Okay, any question on this one? This is very good strategy if you want to own stock in the less price.
So when we are selling the put, we are not buying, but
No.
it will just, right? We are not buying, but we can sell that.
Yeah, you can sell that. It's kind of short selling, like short call, like short put. Okay, they will allow you short put, and you are telling in case stock goes down, you can still own it because I like this stock. Even if I buy at 20, I don't care. Okay, and
how we are making money on that? So we will.
that's what okay, yeah, that is yeah. For initially beginners, that is a good thing. So when you sell, Okay, this is a credit. That is, it is going to your pocket. Okay, if, as I said you, if this stock doesn't go to 20, you keep this money in your account. It will automatically expire. Okay, when it expires, what happens? This value becomes 0. So suppose from someone you borrowed some money, right? 2,000, right? You borrowed some 2,000 money. Now he said that I'm giving you 100% discount. That means you don't have to pay me. Okay, what does that mean? You made the 2,000 profit from there, right? Means you gained 2,000 because you don't have to pay them, right? That's that. So suppose you took a loan from bank and bank says I'm slashing 70% discount on this one. Like in India, sometimes it happens, right? For the farmers, right? What does that mean? That means this subsidy is the same thing. So you sold it, you gained this 230 into your account by selling 5 or 10. Suppose you sent 10, so you are gaining 400 into your account. Now in the expiration, if it doesn't touch 20 and the stock moves to 20, like 25, 26, 27, 28, 29, something like that, right? It moves up. So when the stock moves up, it will lose value. When it lose value, what happens? Suppose you are closing at 0.1, that means you are giving just $200, but keeping, sorry, 0.1, $100 and keeping $300 into your account.
But then we have to buy that stock, right? In that case,
not buy that stock. You just closing this one. Okay. When you'll buy that stock, when the stock falls below $20.
okay.
Is that clear?
So we are selling this for $20, and if
not
it won't reach,
$20, you are selling this strike $20, 20 strike, not $20. You are selling this strike 20. What does that mean? If the stock falls below $20, they are going to assign the stock at $20.
Okay.
But if the stock stays above 20, you keep the whole premium here. In this case, you are pocketing the money first, you are giving it later. Okay.
It
That is
doesn't
called
matter how
credit.
much increase it.
Yeah, it is called credit. But in this case, if I'm buying this one, right, I'm paying from my pocket. This is called debit. I'm paying from my pocket. Okay. And if it goes 0, I lost $200. Do you getting it?
Okay. And in the other case, how much, do we lose anything?
Yes, you lose. You lose. If the stock comes down to below 20, you lose.
Okay. And how much? What's the, we won't be losing, the same amount if you buy that, right?
No. Suppose when I say below 20, suppose stock is closing at 15 by January 21, right? You sold 20. Okay. Now they are going to assign you the stock at 20. Okay. Don't take any actions if you don't want to. Okay. You want to hold the stock at 20. If you don't take any actions, okay, there are some actions you can take. But if you don't take any actions, they are going to assign the stock at 20. Okay. That is you bought that 100, how many thousands? Okay. 10 contracts, so 1,000. And 20, your stock is trading as 15. So how much you lost here? $5, right? So 1,000 minus 5, you are already losing 5,000.
Yeah, but we will still have a stock, right?
Yeah, you will have the still stock.
So
yeah.
exactly, and with the stock can go up tomorrow. So it means that literally right at the point we are not losing anything. We are having a stock, and maybe if you want to decide to sell up, then you are losing. If not, we can keep the stock and we can wait for it
Exactly,
to go again 20.
So so basically $20 they assigned, but actually you received how much? Suppose 0.45. Suppose for the calculation you received 0.5, right? So 20 minus 0.5, actual cost is 19.5. Getting my point?
Yeah. Right.
Actual cost of the stock is how much? 19.5. Now stock is trading as 15. So you are actually in the paper loss is how much? 4,500. Okay. On 1,000 stocks. Okay. But you can start selling what? Like 21 calls, 20. Yeah. So you can start selling covered calls. So you can what? Average your buying price. Now, after some time, stock suppose moved 22, 23, 24, then you are already have much profits. Got it? But the thing I said you should like the stock. Don't
Mhm.
trade the stock you don't like. Okay.
Which has potential, basically.
Because suppose somebody says Apple, right? Just
Mhm.
for example. Okay. Or right now Baba, for example. This is a perfect example. Okay. Baba. Baba went down with the news.
Yeah.
You guys
Yeah.
know about that one, right?
Mhm.
Yeah.
This is Baba. So I like this stock. Okay. And if I draw the line, it's already the support. And mostly it may go down a little more. But if I want to own this stock, doesn't matter after this Baba goes down more, but still I want to own, what I'm going to do is, suppose Baba is selling 222 right now. I want to buy this stock. Suppose I can go ahead and sell this 200. Okay. And sell one, right? I'm paying how much? I'm getting how much? 200, $15.
How much? $15. 215, right?
215.
Okay.
Now Baba comes down.
Mm-hmm.
Baba comes down and suppose stays above 200. I keep that 215 in my account. Okay.
Okay.
But if Baba comes down to below 200, then they will assign me the stock 200. So how much exactly I'm paying? 198 something. Okay. But even if it goes down to 200, I still like it. If it goes down, I'll buy more.
Can,
So in
can,
this,
can we
Mhm.
can we go ahead and close it at any point of time?
Yes, any point of time, you can roll it, you can close it, you can roll it, you can do whatever you want.
Okay.
So one thing I'm not getting. So we are buying, but the stock is getting assigned to us, but
Yes.
what we are doing is selling.
You are selling a call, short selling. This is
Okay.
called put. This is called put right. This is called, yes, a lot of people say it put right, write a put or sell a put. So when you sell a put, a lot of people do this one. The stocks they like to do own it. Okay. Because they can get, so the other two advantages. One is they can get the stock at their own price. Okay. Even if they didn't get it, they keep the premium and they keep doing it next month too.
Okay. And so that I got it. But and if it goes above, right? If it stay above 200, like 220 or 230, then still we are going to make the profit.
Yes, that's how you keep the whole premium.
Okay. Okay.
Your intention is it has to stay above 200
Oh.
so that you can keep the premium.
Awesome.
The
Okay.
problem is in case it goes down,
Then
okay,
we are owning the stock.
you are owning the stock. Yes, you got it. For one contract, 100 stocks you are owning at 200. That means 20,000. Okay. But
Okay.
you actually are paying 100, 198. Okay.
And we are owning the stock, and it's up to us when to sell, basically.
Exactly. It's up to you. You want to keep it or sell it. Okay.
Mhm. Mhm.
And if you want to keep it, then start selling the covered call. So you got 200. Now stock is trading at 205. Immediately it went up or something, and you can sell 210 or 205. So in case it calls out, then you are still in profit above the buying price.
Gotcha.
so for selling puts, do you prefer like 1 week or 1 month, or what is the expiry we should choose?
See, it depends on it depends on the experience of the trader. Okay. So if you are comfortable, go ahead in 1 week, and basically experience as well as you have to see how much premium you are getting and you are okay with that premium.
Mhm.
You understand? Okay.
Yeah.
Basically, there is another factor called implied volatile IV. Okay. Most of the time people look into IV, but that is too much complex. Again, I don't want you to go to complex. Okay. You just focus on the strike. Okay. See, if you go further out, right, you go March 21, you'll get more
Premium.
credit, more credit. But the problem is it will not lose value immediate like this one. Okay. So you want to pocket the money as soon as possible.
Right.
You understand? Okay.
Yeah, that makes sense. But it should be some criteria. Delta should be less than minus 0.2 or something, or
You
like what?
can do, or you can do a lot of whatever you want, 0.15, 0.10. I said you have to like the premium you are getting. Got it? It's not delta. You have to like the premium you are getting and the margin you are holding. Okay. Like this one. This one has, see, this account has grown this year $500,000. You see the year to date? This guy withdraw 100 something to buy a house. Okay. And left over with this one right now. Okay. So now if you see 160, this is my brother-in-law's account, by the way. I'm managing. So if you see how much you are going to get it, so you just sell it and you say premium sell this one 215 preview. See 160, 155, right? It is holding 5,000 for this trade. How much I'm getting? 200. Okay. To get 200, I'm holding how much? 5,000. There are some other brokers which charge less margin, but this is something you have to work out. Okay. But this is a strategy just for yourself. Okay. If you are not going to take any risk, you like the stock, you want to own it, and you want to at the same time make some money, try doing this. And in our group, there are few traders who does most of the time every day or every month. You can follow them. Okay. So you can make a lot of money monthly. Okay. That is another separate strategy. Okay. So that is about selling a put. In case any issues, any questions, you can sometimes ask me or ping me, something like that. Okay. Let me go through the quickly. So this is a trade discussion where you can have the discussions like we are having all the time discussions here. So I can see here. Show any news, this, that, something like that. And okay, regarding tradings, you have different. So I'll prefer E-Trade all the time. Squab is there, Thinkorswim is there, Robinhood is there, Testyworks there. I don't recommend Robinhood, but Testyworks is also a good one. They require less margin for selling a put. Just for your information, E-Trade is very good for paper trading if you want to do that. Even Squab doesn't have paper trading, but this guy has Thinkorswim, that is TOS, has paper trading too. If you are comfortable, you can do that. So just decide which one you want to go through. How to do paper trading in this one E-Trade? You can go here in this one. If you log into E-Trade, here is the one, and you can click on this right here, Power E-Trade, then paper trading. Click launch, and it will give you 100,000 or something like that dummy money. Paper trading is nothing but practice trading. There is nothing. You are just replicating. Okay, and you can do some practice trading here. Okay. So the same way you just do it. Sometimes the price will fill up, sometimes it will not. Just do here and trading. Go to whatever you want to practice. You can practice selling a put, this, that. You can save it spread. Okay, so you can do that. You can also join our group, and you can. I'm just posting this one in case you didn't join. So I forgot to put this one. You could have done this one. Maybe a lot of people left. But where is the chart here? Oh, sorry. It's too much. It is not copying here. Okay. So that is that one. Okay, in case you want the full course of the stocks, analysis, options, everything, and which will cover a lot of all these things, okay, and I think more than that one, then you can be on the waiting list, okay, for the next class, okay. So you will have all in and out, okay. And you can also join the Facebook group if you want, so to stay on the top and some discussions. So this is the group. Sorry, I don't know why it is not copying here. This is the Facebook group. You can connect and see some updates. Most of the time, we'll post a lot of updates and some trades, not all the time, and some financial news updates. And that's it. Any more questions, guys?
Hey, RK.
Yes, sir.
Hey, you said for a CDS, we expect the stock should go up, right?
Yes.
What in this scenario? Let us think. Okay, I expect there is a stock which will go down. So which spread is better?
Put spread.
Is it put debit spread?
Put debit spread. Yes.
Okay.
Same way.
Okay. Do you know how do we choose those numbers? You select two, right? One buy call and a one sell call, and you put the strike price. I saw in chat window a lot of calls is a margin of $10. Is it any specific metrics for that, or you have always will keep those $10 margin and between the before?
No, it depends on a lot of factors. Okay, but yeah, for the time being, because I do it most of the every time, so it doesn't take much time for me to guess it. So, but yeah, so if the stock price is too high, kind of, suppose take Amazon, right? Amazon, if you want to trade, debit spreads $10 strike will not differ much. Okay, so you have to, if you want to trade Amazon, at least you have either $40 strike or $50 strike. Sometimes $50 strike is a good one, or $25 strike, something like that. Difference.
Okay.
Yeah, because otherwise the price, they will not match. You will be cheated.
Okay. Yeah. Thanks, RK.
Thank you, guys.
RK.
Yes, sir.
I have one more last question. This registration, right? Initially, I took the free account, the 14 days free trial. That time I registered with my user ID and password. And after 14 days, I took the annual plan. So I registered myself again with a new ID. Now I have two IDs. I think one is not working, and another one I just try to log in, but even that is not working. Is someone can fix that?
Now, Discord, if you are working, this is where you get the charts, right? Discord is main. So if it is working, you're good. The other one, that is for the website, just to keep your status, see your status, like kind of payment status and stuff, right? So that is for yourself. That has no link for the trades, but the soon we are coming up. Basically, I have not started the trade alerts here. If you go to the trade alert, I don't know, stupid, why it is most of the time. So here only the logged in members can see the trade alerts like Discord. Soon we'll integrate that one, but I have not started it. So, but that is the main intention. So you can log in here and see your subscription status and stuff.
Okay, one last question, RK. You were talking about those 100K challenge, right? What is that 100K challenge?
Yeah, you can go to this page and have a look. Come on. $100K challenge is basically will take 25K to 100K.
Okay.
In a 1 year or 18 months.
Do we need to? What is the prerequisite? We need to have that E-Trade accounts, or need to keep that
all the
balance,
informations are written here, and if you are interested, just put your name and email ID, sign up. You will get a welcome mail and stuff.
Okay. Okay.
Any other questions from other folks? If you guys need any clarification, you have the mail ID which sent from this one. You can definitely drop any questions, some valid questions. Okay. And Not like I'll suggest you any trades, but definitely I can clarify some doubts. Okay, so making sense? Mhm.
Yep.
If I conduct any more sessions like these pre-sessions, maybe next time I'll hold for 2 hours. I think 1 hour is not having sufficient. So, but people will run away for 2 hours meeting, right? So, but it's a kind of I cannot cover a lot of stuff within 1 hour or 1.5 hour. So,
I think looks like we need another session, RK.
uh,
Discussing another threads. You explained only CDS.
yeah, there
Uh,
are put credit spread, and there are a
yeah.
lot of things. That's what I told you. If you want more sessions, actually it's a 12 to 16-hour session. Okay.
Okay.
So it's not only 1 hour. This is just to give a overview of this one, how to do it. But if you definitely, the thing is wanted, you can do the paper trading. And once you do paper trading, you join. What is your duty is only to execute the trade. That's the thing.
Right.
So
Right.
if you know how to execute the trade, you don't have to exercise which strike, what I'm doing, all this stuff. That is what I mean to say. Okay. So the only thing I wanted to know you is because when I post the alert, so 270 by 280 call, that means 270 I'm buying, 280 I'm selling. So this is a CDS means call David spreads. Similarly, low, this one call vertical, the same thing. These are all call vertical and stuff. Okay. So there's CDS. Okay. So
What is that cell one, the top one? The
what is
Baba
that?
you said, right? Yeah, that one.
This one, yeah.
Right? That's a put vertical.
Yeah, this is the put vertical, but that is closed actually. So
This is something where we expect the stock should
no,
go
this
down.
is PCS, put credit spread means I expect stock to go up, but unfortunately stock went down next day. Okay, so
Okay.
because that's the bad news. Okay.
Yep. Yep. Yep.
RK, I have a quick question.
Yes, sir.
The question is regarding the spreads. In TD, I have that level 3 approved for the options, so I cannot do spreads.
Level 3, you should be able to do the spreads.
I tried that, but
Only thing you cannot do is you cannot sell like a naked call.
well, okay.
You cannot
Right,
sell
so-
a naked call. You can sell credit spreads. You can sell debit spread. You can do debit spreads. You can do credit spreads, but you cannot sell a naked call. You can sell a put, naked put.
Okay. So should I apply for level 4 or how should I go for that?
If you know the risk of level 4 selling a call, then you can. But even I had the level 4, I denied. I had to take it.
Okay. So regarding the futures, if we don't have level 4, we cannot play any futures.
Futures is totally different animal.
Got it. So I tried and it won't let me do any spread. So I will check again tomorrow.
Yeah,
So why
talk to the
giving me-
customer support. Yeah.
Yeah. Okay. Got it. Thank you.
You're welcome. Okay, guys. So we'll wind up here. And any questions? You have the email ID, and if you don't have the email ID, just let me put in the chat window again. But this is a different email ID again. Okay. So support at the rate.
Can you please come up here?
Options. If you want a full course, definitely no, I can arrange a training session. Okay. There are 3-4 guys are already lined up, but if you want a full training session, just show your interest, send me an email, and definitely I can have from starting to ending. Stocks, options, charts, analyzing credit spreads, closing, open, close, everything. Okay. So you will be full master on your own. Okay. Making sense?
Okay.
Yeah, if
Thank
you
you.
don't know, yeah, thank you.
Thanks.